Hey, welcome back to The Dive. Today on the show, we have the senior macro strategist at Bloomberg, Mike McGlone. We're going to get Mike's take on where the Fed goes from here, Bitcoin's recent rally, oil, gold, corn, and be sure to stick around to the end to hear Mike's top commodity for the year. Hey, Mike, welcome back to The Dive. Thank you so much for joining us.
Hi, Cassandra. Thanks for having me.
Okay, so Mike, the Federal Reserve raised rates by 25 basis points, as was widely expected. Where do you think the Fed goes from here? Are we going to see more hikes ahead?
Well, they say so. I think so. The market's price for it. The key thing is the market's price for them to start easing later in the year. And I think the only way for that to happen is for markets, most notably the stock market, to go down hard. And that, to me, is the part of the lose-lose for risk assets right now. The key fact is the central bank is still tightening. The don't fight the Fed mantra, which was the case a year ago, remains the same. And a year ago, Fed funds was 0, and now it's almost 5% and still rising. It's called this rule of lagging performance and lagging implications for markets. A long and variable lag is how these things usually work. So we're not going to feel the apex of these tightenings for at least maybe another 6 to 12 months. And everything's starting to roll over. Now we have just had short-term rallies in equity markets, and we've had a pretty decent bounce this year. But I view that as fighting the Fed, and good luck with that one.
Federal Reserve Chair Jerome Powell said in a news conference that the economy's disinflationary process has started. What are your thoughts on Powell's recent statement?
No, completely. Well, he's pointing out the obvious. Thank you very much. And they better, because it's if you don't believe in the rules of monetary supply and the effect on inflation in the economy, and the biggest pump in liquidity in history that's dumping, then I fully expect by this time next year, we're going to be talking about why is the Fed not easing more to help us get out of this recession. Now, recession is priced in for about 100% from our Bloomberg economics team, Anna Wong. If you look at the yield curve, 100, you're supposed to have a recession. And the question I ask is what stops it? The Fed is still tightening. So I think we're going to have significant deflationary forces by this time next year. I think we're going to have CPI printing negative. Now, this will be measured on a year-over-year basis. It's already happened in things like crude oil. Crude oil went up to 130 last year. Now it's dropped 76. The world's most significant measure, and this country's most significant measure in the U.S. and Canada for heat and electricity, natural gas has plunged. It was a darling in the rally. It's now at the same price as it was in 1990. That's 33 years ago. That's significant deflationary forces resuming. The only thing that's been somewhat inflationary this year is we've had that bounce back in almost all risk assets, and I think that's going to start trickling back down to the reality of recessions. You know what happens in recessions? Markets typically go down, earnings decline, bond yields and gold usually, bond prices and gold usually rise.
The S&P, Dow, and NASDAQ rallied following the interest rate announcement. Do you think that the markets are calling the Fed's bluff and making it less likely for a pivot?
No, I think what's happening, Cassandra, is people are making too much of massively leveraged positions when you hit a trigger to hit the stops and take them out. That used to be my job. I was one of those positions who ran a lot of the positions. I was on the phone covering clients who did a lot of that. The market's so overloaded with lots of puts and speculative and interest and hedging to protect themselves. We got to flush those people out, and then we go down. The macro of the market is key thing to remember in bear markets, the biggest rallies happen in bear markets, and I'll leave you with this. I think this is a 1929, 1930 scenario. Stock market dropped about 50% in 29. It bounced about 50% to the peak in 1930. I think we're repeating that. And here's my main backup. The Federal Reserve is still tightening. And economy's heading towards recession. Stock market probably has, from last year's decline, maybe another 20% decline in a normal recession.
Bitcoin has rallied recently. What do you think is driving the price of Bitcoin right now?
It's the exact opposite of last year, Cassandra. Bitcoin is rallying because everything's rallying. It's just Bitcoin is the world's most fluid, 24/7 leading indicator, and it led on the way up. It led on the way down. It's bouncing this year, and I think Bitcoin's more likely to come out of this whole scenario ahead. So the way I view Bitcoin this year is it's short covering. It's a bounce in the bear market. It might have put in a bottom last year. I think that's unlikely. Bottoms are usually not V-shaped. They're usually not that easy. They have to really purge people and make it difficult. but it's the leading indicator. So I think it's more likely to turn back lower. It might not take a new low. I think in the big picture, it has the highest propensity to continue its long-term enduring upward trajectory. But right now, it's very suspicious. Remember, everything that went up last or down last year has bounced this year. And it's almost been the exact opposite. When we had that big rally in energy and commodities, they've all done the opposite. So we're reversing last year in the first month and the time of the year when you put on new positions and have the hopium. And I think the reality of the Bitcoin and cryptos facing its first recession is going to kick in. Recessions are bad for risk assets. Bitcoin's still risk asset, but I think at some point it's going to transition to more of a digital version of gold and treasury bonds and come out of this ahead. The unique scenario will be if we don't get a soft landing, but my base case is one of the most significant global macroeconomic resets in our lifetimes, worthy of the pump in liquidity, the dump in liquidity, the war, and the amount of Federal Reserve tightening, and most central banks in history still tightening rates as we speak in February.
Now let's talk about earnings. ExxonMobil announced a $56 billion profit for 2022. A record high for the Western oil sector. Additionally, Shell reported its highest ever yearly profit of $40 billion for 2022. What does this data tell you about the oil market?
That the more supply will be coming on. First of all, it's reciprocal. They got crushed in Q1 20. They've been hurt really hard during this oil bear market that really kicked in 2014 and got to some significant lows in 2015 and 18. And now they're just making some of that back because that's what their business is, to make money, produce oil. And then when price oil goes up, you should be able to make money. They're part of a lot of pension funds and endowments and things like that. So that's been the good hedge last year, is owning the energy companies. Now they have a right to own the company their way they want. And part of the issue is the U.S. government, from a top-down standpoint, has made it very difficult for them to drill, to create more oil. So they're doing what normal companies do in a free market capitalist society. Now I'm fully expecting more supply to come on because of so much profits. But capitalist companies, to make money, that's the essence of capitalism. And don't forget, they lost a lot of money and lost some very bad quarters when crude oil prices were down. And guess what's happening? Crude oil and energy are going down. And part of that reason is because suppliers can create more. We've had classic elasticity, supply and demand. And the key thing that's happening right now is demand destruction is still in early days on a global basis.
Your February commodities outlook stated that $40 crude may pave the way towards $3,000 gold. Can you give us some more color on this?
So we've had the way I view recent activity last few years is gold has been in an enduring bear market. It had a bounce last year. It's going to that bear market tendency. It's one of the most autocorrelated commodities on the planet. And it's the price right now, and the screen's around 76, was first traded around 2006. That's not a bull market. And every time it goes up, more supply comes up, demand goes down. It's a bear market going back to that trend. Gold, on the other hand, is an enduring bull market that's had a dip in that bull market, and it's just bumping up against that $2,000 an ounce resistance level in terms of dollars. Now, it's made new highs in terms of the euro. It's made new highs in the yen. I think it's just a matter of time it does it in terms of the dollar. And part of that is the deflationary aspects that we're seeing in energy and commodities. I mentioned natural gas, the lowest price, the same price as 33 years ago. Crude oil, the same price as 2006. Those deflationary forces are kicking in. At some point, that's going to show up in the economy. It's already showing up in housing and demand for unleaded gas and used cars and so many things. It's just the key trigger, I think, for gold to break out higher is when the Fed pivots. I didn't say if, when. Market's pricing for that late in the year. A key thing for that to happen is we need the stock market probably to go down to make the Fed to start worry about deflationary forces, which kicks gold in. So crude oil is on trajectory towards $40 a barrel. That's basically the average cost of production in the U.S., the world's largest producer and consumer. Natural gas has already done it. The average cost of production is around 2. Natural gas was around 10 last year. Right now it's in a 2 handle. To me, it's a matter of time it goes back there, particularly as we head towards recession and those demand destruction forces continue to kick in. And remember, what's happening? The world is tilting towards recession, yet we still have the most central banks in history still tightening and the Fed's still tightening, which means we're probably going to get that recession. At some point, they're going to pivot. And then I think we're going to head towards that enduring deflationary recession. Boosts gold. It's bad for crude oil.
What do you view as the key price level for gold?
Well, right now it's $2,000 an ounce, and I look at that. It's just bumping up against that resistance. It's bumping up. It just can't wait to get through. It needs that trigger. Stock market going down, Fed easing, things like that will do it. I think it's already done in terms of euro and yen. So getting above $2,000 an ounce, I think, is a matter of time. And once it does that, it's going to never look back. I think it's going to get to 3,000 rapidly in my base case scenario for a severe global economic reset. So what can push back on that? Maybe some kind of soft landing. And then we'll see if that happens. I think that's unlikely, particularly as the Fed says they will not be easing. Okay, that's usually what supports that stock market. So means they're going to have to force them to ease. And what forces to ease? Lower asset prices, lower deflation, and that's what'll get gold going, I think.
How do you think producers will respond to the recent price action?
In terms of energy and commodities?
In terms of gold producers, sorry.
So gold, yeah, and we're on gold. The way I look at gold is sure there'll be more gold coming on as prices rally, but we have to get past it. Typically, the supply will come after the rally, which is normal. The average increase, an annual increase in gold supply over time is 2%. So maybe when it pops above $2,000 an ounce, that will increase. But it'll also increase demand just as not, if not more, because I think it's a bit of a paradigm shift for gold. But for the U.S. stock market, stop outperforming the world. And to not have that alternative asset. And then you have that period where everybody who's spent a lot of money in equities last year gold to gold. So supply will come on, but it'll be more of elastic. And that's the key reason gold outperforms virtually all commodities in long term, most notably on a total return basis, because you never can really increase the supply with the elasticity you can with other commodities. It usually comes from inventories. And I think there's going to be more of a hoarding gold environment as it starts showing its color for outperformance of the equity market.
In 2020, Mexico announced that they would prohibit genetically modified corn by 2024. Given that Mexico is the biggest buyer of U.S. corn, do you think that this will have an impact on the market?
Yes, I'm bearish corn because corn still has a decent war premium from priced in from Russia, I should say, Mr. Putin's invasion of Ukraine. On a 12-month basis, it's one of the few major commodities up 8%. It's around $7 a bushel. I think it's going to $5 by the end of the year. That's where the D's contract for corn for this year is priced. I think it's going lower. It's only because of supply and demand elasticity. So I'm bearish corn. That adds to it. But that's a kind of, I think it's an initial silly statement from people from countries and stuff when they don't understand the new technology. It's that rapidly advancing technology that's kept the price of corn unchanged for about 20 to 30 years now. It's probably going to maybe get to near $4 a bushel. And the key thing I'll leave you with is it's that key it's the Malthusians who've been getting it wrong in history. Population growth is not as bullish for commodities. It's that human ingenuity that keeps commodity prices low, and corn's a leading one. So the average yield of 1 acre of corn, I owned a corn farm in Indiana quite a while ago, this year is probably double what it was about 50 years ago. So that same acre of land gets double the corn. Why? And we actually use less fertilizer. It's just rapidly advancing technology, creating more with less. Where's that trend going? It's continuing to go higher. We need basically a bad weather year, I think, for corn to go higher, which is part of my whole bearish scenario for commodities.
So which commodity do you think has the most potential this year?
Gold. So I think what happened last year was put in a significant foundation for gold and a significant peak for crude oil and most other commodities. As we head towards a deflationary environment and supply and elasticity kick in, the global recession kicks in. China demand maybe on a 1 to 5 basis is a 5 potentially for commodities. On a 1 to 10 basis, the 10 is the overwhelming force of Fed tightening. The most central banks in history still tightening as we tilt towards recession. So they're going to back up some point. They're going to have to ease. And then to me, one of my favorite commodities, I think, for this year is most likely to appreciate is gold, along with U.S. Treasury long bonds with declining inflation. We'll see how that works out, but my job is to have a view.
Okay, great. Well, that's all we have for you today, Mike. Thank you so much for coming on. Before you leave, could you let our audience know where they could go to get more of your commentary?
So I'm at LinkedIn and at Mike McGlone 11 on Twitter. Look for me there on LinkedIn if you're interested. Just reach out. I'm happy to add you to my distribution list. And Cassandra, thank you. I love your rapid fire questions.
Thanks, Mike. We'll see you next time. To our audience at home, thank you so much for watching today. We will be back again tomorrow with another great interview that you're not going to want to miss. So be sure to stay tuned by hitting that notification bell and subscribing below before you leave us. Bye.